Okay, Chapter 8, Flexible Budgets, Overhead Cost Variances, and Management Control. Okay, there are a lot of actually big objectives for this chapter, and we'll see how far we get. I thought I'd be able to figure out where we'll stop, but let's just see. So the first thing we do is look at the differences in planning for variable overhead costs versus fixed overhead costs. And even though this isn't, the normal stuff that you study in accounting for this, it's a really interesting connection. So you want to pay attention to this. It's a very good thought. It would be fun to see this at work at some point, I think. And then develop budgeted variable overhead cost rates and budgeted fixed overhead cost rates. Then compute the variable overhead flexible budget variance and the variable overhead efficiency variance and the variable overhead spending variance. Okay, then fixed overhead flexible budget, fixed overhead spending, fixed overhead production. All right, so we have several layers of variance that we're looking at in here. Then show how the 4 variance analysis approach reconciles total overhead incurred with the overhead amounts allocated during the period. Then explain the sales volume variance and production volume variance. Calculate variances in activity-based costing, and then examine the use of overhead variances in non-manufacturing settings. So here we find information on the planning of variable and fixed overhead costs. And the planning of fixed overhead differs from the planning of variable overhead costs in another regard as well, the timing. At the start of a budget period, management will have made most of the decisions determining the level of fixed overhead costs to be incurred. Okay, but it's the day-to-day ongoing operating decisions that mainly determine the level of variable overhead costs incurred in the period. So fixed overhead has a much longer time frame. And the other really part that I thought was interesting was in planning variable overhead costs for a product or a service, managers must focus on the activities that create a superior product or service for their customers and eliminate those that do not add value. So in planning for variable overhead, we're really focusing on the value-added activities, okay, things that are core and really important to the organization. Now, planning fixed overhead costs is similar to planning variable overhead costs. Undertake only essential activities and then plan to be efficient in the undertaking. But there's an additional strategic issue when it comes to planning fixed overhead costs, choosing the appropriate level of capacity or investment that will benefit the company in the long run. Okay, so this is really a long run view. And this is a quote from the text. I put it in the PowerPoint because I just want to make sure that you see it. Focus on activities that create a superior product. So this isn't just accounting or calculating variances. You're really being strategic about what variances you copy, okay, which ones you really follow, which ones you pay attention to and make sure that you've got a model to support. Like this company expects jackets to last, so the managers consider sewing to be an essential activity. So the maintenance activities for sewing machines, which are included in their variable overhead costs, are also essential activities for which management must plan. And such maintenance should be done in a cost-effective way, such as by scheduling periodic equipment maintenance rather than waiting for sewing machines to break down. And in all the companies that I've worked with, I haven't seen this actualized. I haven't seen someone plan the overhead and and do it strategically. Okay, for many companies today, it is critical to plan for ways to reduce consumption of energy, that I've seen, and rapidly growing component of variable overhead costs. So now standard costing. Okay, it's a costing system that traces direct cost to output produced by multiplying standard prices or rates by standard quantities of inputs allowed, okay, for actual output produced. Okay, that's what standard costing is. And we kind of used it interchangeably in here between standard and budgeting costs. It also allocates overhead costs on the basis of the standard overhead cost rates times the standard quantities of the allocation bases allowed for actual units produced. Okay, so it's just think about the right side of the variance analysis sheet. Okay, it's for this. It's going to be standard quantities of actual outputs produced. Now you've got steps to follow in developing a variable overhead cost rate. Choose the period, select the cost allocation basis to be used, identify the variable overhead costs associated with each cost allocation base. Okay, identify the variable overhead costs associated with each cost allocation base, and then compute the rate per unit of each cost allocation base used to allocate to variable overhead costs to the output produced. Okay, so compute the rate per unit of each cost allocation base used to allocate variable overhead costs to the output produced. So fixed overhead costs are by definition, all right, a lump of costs that remain unchanged for a given period despite wide changes of activity within the relevant range. And these costs are fixed in the sense that unlike variable costs, fixed costs do not automatically increase or decrease with the level of activity within the relevant range. And you'd be surprised, but actually the fixed overhead cost variance is the hardest one to do. The variable kind of makes sense. The fixed is tough. So the process for developing fixed overhead cost rate is the same one as the variable. Choose the period, select the cost allocation base or basis used to allocate the fixed overhead cost to the output, identify the fixed overhead costs associated with each base, and then compute the rate per unit of each cost allocation base used to allocate fixed overhead costs to the overhead produced. I hope this is helpful. I've got my doubts. So now let's look at variable overhead cost variances. This is flexible budget analysis. And as seen here, the variable overhead flexible budget variance measures the difference between actual variable overhead costs incurred and flexible budget variable overhead amounts. Okay, so now we're in the far left column for actual, and then moving to the middle with the flexible budget. So your flexible overhead budget variance is actual costs incurred minus flexible budget amount. Okay, and then we take it and we break it down one step more into variable overhead efficiency and spending. So spending is over here, and we're going to look at some charts too that will make more sense than this. But spending is over here, that's the difference on the left side, and efficiency is over there. Efficiency or usage, you can think of it as. As a reminder, the flexible budget amount will be calculated by taking the budgeted input allowed per output unit times the budgeted variable overhead cost rate per input unit. If, for example, our actual output was 10,000 units, the budgeted machine hours were 4,000, and the budgeted variable overhead cost per machine hour was $30, the flexible budget would be calculated by taking 0.4, okay, 4,000 divided by 10,000 to get machine hours per unit times $30 times 10,000 actual units. Okay, so the variable overhead flexible budget variance can be further broken down into the variable overhead efficiency variance and the variable overhead spending variance. So on this slide, we see the formula for variable overhead efficiency variance, which is the difference between the actual quantity of the variable overhead cost allocation base used for actual output and the budgeted quantity of the variable overhead cost allocation base used for actual output times the budgeted variable overhead costs of the cost allocation base. This is crazy, isn't it? let's look at some real formulas here. Here's variable overhead spending variance, difference between actual variable overhead cost per unit of the cost allocation base and the budgeted variable overhead cost per unit multiplied by the actual quantity. Okay. I actually think we've got journal entries here. I want to go to this other slide. This one here. Okay, here is a good illustration of variable overhead of the variance analysis. And here's our actual costs incurred. And we have actual input quantity, 4,500 hours, times $29 an hour. Okay, gives us 130,500. This was our actual input quantity and the actual rate. Now, for the, let's look at the flexible budget then. That would be the budgeted input quantity allowed for the actual output. Okay, so the budgeted quantity allowed, and this was the formula I was talking about before, that was the 4,000 divided by 10,000, so it's 0.4 hours per unit times 10,000 actual units, okay, times $30 per hour. That was the budgeted rate. So that's 4,000 hours times 30, or $120,000. Okay, and then for the flexible one in the middle, that is the actual input quantity times the budgeted rate, which makes sense. And then before you do anything, pull back and look at these numbers. We've got 130,000, 135,000, 120. They're all at least in the same era. Okay, you don't have crazy numbers in here. If you've got $1 million in here, something's wrong. Okay, it's just not right. So make sure that everything's sort of in the same family. We're going to take these variances and break them down. The first we've got, this is our total flexible budget variance here, from actual to the flexible budget, and then break it down between spending and efficiency. Okay, and this is spending because the only difference here is this rate per hour. So $29 per hour, and the budgeted rate here is $30 per hour. Okay, we're using the same actual quantity of input quantity of hours. It's 4,500 hours. Over here, for efficiency variance, we have a difference in the number of hours. These are the standard hours allowed, okay, at $30 an hour. These are the actual hours allowed at $30 an hour. So the only difference we have here is efficiency. Okay, I think we need to do some problems to see this better. Yeah, let's stop right here and do some problems, and then we'll pick it up at fixed overhead.